Go beyond market headlines to understand the reasons for the day's movers and shakers. And get your portfolio ready for tomorrow. Beaming live from the CNBC-TV18 Motilal Oswal studio.
A mixed picture, but largely in the green is what the Asian screen is suggesting.
The big cut, of course, was in the Nifty stocks, not so much in the Nifty Bank. And, of course, the broader markets actually, if anything, ended higher. The mid-cap index is up. The small-cap index I can spot is about 0.75% in the green.
Globally, every market is, back to what they were 2, 3, 4 months back, and so is maybe Indian markets.
Close to about 0.4% on the benchmark indices. Mid-caps faring better.
The commentary from the management itself ahead of their con call here on CNBC-TV18 was extremely positive.
You're able to bring up the overall all commodities index to 0.85%.
There is skepticism over the actions by Pakistan and the kind of provocative statements which have been made.
We're actually seeing a little bit of a sell-off, especially as far as the bank Nifty is concerned.
Hello and welcome. You're with us on Closing Bell. We're here with the last 1 hour. And it's been a more quiet day for the market. No major moves, and we've kind of given up a little bit from the highs of the morning as well. I'm Surabhi Upadhyay. As always, with me is Reema Tendulkar, and today Nigel's here with us in the studios. Hi, guys.
Hi, thanks for accommodating me.
Special day, we have you with us.
It's our lucky day.
Yeah, but it's, though the headline index is not indicating that much of gains, but actually the broader markets are looking good. You still have a number of stocks advancing in the ratio of around 3:1. So you'll have to say that maybe the headline index goes through a period of consolidation. But after getting hit hard, it appears the broader markets now, the excitement is out there. And individual stocks, a lot of them giving decent numbers. And you're seeing stocks that are flying away in today's trading session. You have GRSE, you have HAL, many stocks in today's trading session that have done well, KPI Green as well. So just to name a few, a lot of stocks have done well. And stocks like VIP that actually delivered a poor set of numbers, the stock's down 2-3%. In another market, the stock would have easily been down 10% with the awful numbers that we've seen from a company like VIP. So clearly, the street is looking ahead.
It's just disappointing to see the way banks have sold off, and perhaps it's smacking of FIs selling, which might come through. But the Nifty banking index is down 240 points right now at 231 hour to go. But from the session highs, it slipped close to about 500, 550 points. So, and it's heavies like HDFC Bank and ICICI Bank, Kotak Mahindra Bank, across the board. Banks are weak in trade. In fact, even the Nifty and the sensex has come off quite a bit. So selling pressure, profit booking did creep in as the day progressed. The high today on the Nifty was 24,767. As we speak, we're 24,616. So lost about a good 150 points from the day's high. And, it's been through the day. The first hour was good. Markets open strong. And then you're slowly seeing this profit booking creep in.
Absolutely. I just have one worry for this market from a tactical point of view. And that's competition from China. Look at what the Chinese market's done today. Look at the Hang Seng. The closing there is 2.5% higher. There are gains in the mainland China markets as well. So in the short term, will FIIs make that tactical shift towards China? That's a question we'll try and address with our guests on the show as well. But first up, lots of stocks and lots of earnings in focus. And Tata Motors is one of those names. The stock is actually ending or is trading lower, despite the fact that the fourth quarter was fairly in line with estimates. It seems that there are concerns about the outlook. Parikshit actually caught up with the company's chief financial officer, PB Balaji, and started off by asking him about the demand outlook, which is what the market's concern is as well. Take a look.
Overall demand situation as far as India is concerned is, I would say, is modest, is decent, not scorching. At the same time, neither is there any major concern at this point in time. So I would expect modest growth coming into this year. On the commercial vehicle business, I think the underlying fundamentals of the growth is very much intact, be it on freight rates, be it on interest rates, fuel prices. Overall, GDP growth in the industry economy is good. At the same time, even investment plan for the government also continues to remain strong. So all of them portend well for a decent growth. When does the cycle begin? When does the cycle, which part of the cycle we are in? Very difficult to predict. But medium to long term, no major concerns as far as the CV growth is concerned. On the passenger vehicle growth, I think we did have a lukewarm growth last year. Nothing much to talk about last year. And I would suspect that this year would be an year where it'll be modest growth once again and gradually build back as the year progresses. So overall, I'm quite comfortable with the demand situation in India, and we should be in a position as Tata Motors to continue to do well in this market.
Okay, I would also like to ask you about market share loss in the passenger vehicle segment. In fact, analyst reports this morning have expressed some caution and concern about continued market share loss in passenger vehicles. Would you like to weigh in on this concern and how the company is looking to address that?
I think for me, last year is a year of consolidation, 13.2% share. In many months, we were number 2 in the market. So it's not so much a market loss, share loss issue. It's more about how do we grow market share from here on. In that, there are 2 angles here. One is our product launches start from now on vis-a-vis competition, which was more last year. And at the same time, we also had a challenge with respect to our capacity available on our service network, which created some amount of challenges from a customer perspective. Both these are addressed. So we have an intensive product launch pipeline starting now. And we also have more or less fixed the service capacity issues that were there. And that should ensure that the customer sentiment on that goes up as well. Both these augur well in terms of delivering growth well ahead of the market. And we are quite confident of how we are stacking up as we enter the new year.
Right. Speaking about EVs, you have a 55% market share in the electric vehicle segment. Now, the launches by your peers has, of course, impacted the space. There are more players entering, and there are companies which have increased their sales numbers on a month-to-month basis as well. How do you see competition? Do you think your EV strategy needs some rethink right now?
Not really. We just need to execute that with speed. And let me tell you how we intend to go about doing that. The first focus of the EV business is to drive penetration of EVs in the overall portfolio. I am not focused on market share here. It's more about how do we grow this market sequentially. Last year, we had a fundamental issue with respect to the fleet segment getting into challenges because of FAME incentives going away, as well as some of the EV players, EV fleet players are having a few challenges. And this year, we intend to address that in terms of catering to a wider EV portfolio than what was there last year. So that is going to be an important aspect of fixing the bleeders first. Then in terms of the portfolio itself, we are the widest range portfolio in the market with Tiago at one end, and when the Harrier EV launches, that is the other end of it. And then we have a Sierra that's coming in as well. So this kind of a wide portfolio with multiple range offerings makes us cater to different customer segments well. And that is what we intend to leverage as we go forward.
Okay. All right. Now, JLR, you've met your target of making the company cash positive by the end of FY25. How do you expect to perform on this parameter in FY26 and 27? Given the company's capex plans?
Yeah. There are two metrics that were critical to deliver last year. One was actually three. One was delivering the revenue of about 29 billion, which you have done. Second was to deliver 8.5% EBIT, and we delivered that 8.513%. That is what the final number was, the third decimal point. And third is to ensure that we go net cash. I think all these targets, if you go back in Q2, when there was the aluminum issue that we faced, there was a lot of skepticism on whether we can pull it off. And here we are after 6 months confirming, yes, we have indeed delivered that. So one thing which you want to ensure in anything that we do is the say-do ratio has to be of a very high order. And from our perspective, what we are seeing now is in this kind of external environment that we are currently facing, which is a bit unclear. Because one is, of course, it's challenging. The other is also we are not clear what exactly how it plays out. Take the UK-US tariff, for instance. We welcome really the deal that has been done, which is now reducing tariffs from 25% to 10%. But it has gone up from 2.5 to 10, number one. Number two, even that reduction, we are not clear when does it become effective? Is it applicable for parts? Is it applicable retrospectively? So those are questions that are still out there, and we are hopeful to get clarity on that. Once we get clarity on that, it's our ability, then we'll be in a position to be in a better position to predict what the numbers are going to be. Having said that, what we are distilling out of this situation is that there could be two impacts. One is your demand is likely to be impacted, particularly in the US, for which we need alternate sources of demand, number one. Number two, the tariffs are going to have a significant impact on your costs, and therefore, how are you going to ensure you manage the cost in that environment? So if I look at the first one, that is demand, what we have going in with is US is probably likely to be having a lower growth next year compared to what we had last year. And therefore, we need additional sources of growth. The first market that is looking very good for us is UK, and we would intend to accelerate that. Second is Europe is always a very large market and a market that we are doing well, and it's a market that is starting to stir up, and therefore we'd want to leverage that. China, which had been bleeding, is now stabilizing, at least for us, and therefore we would want to see how much we can build back on that front. And there's an overseas market that is doing very well for us, which is Middle East, India, etc. And there again, we should want to diversify our.
Okay, that is Tata Motors' demand sentiment for JLR remains unclear and challenging in the current environment. Demand is likely to be impacted in the US. So even as the tariff uncertainty, peak tariff uncertainty may be behind us, currently the outlook is still a bit uncertain, and Tata Motors share price is down 1.5%. But Bharti Airtel stock is only up about 0.5%. At the day's high, it was up about 2.5%. It's come off. The conference call is currently underway, so let's quickly cut across.
Our digital portfolio with cloud, which we've launched just now, cybersecurity, financial services, IoT, and CPaaS, and all of these are getting additional investments. Airtel Finance is growing fast, and our new partnership with Bajaj Finance will further bolster our portfolio. On the payments bank, our monthly transacting users now stood at just under 100 million. They're at 96 million, growing 10% sequentially. The annualized revenue run rate stands at 2,900 crores, which has grown by 35% year on year. Deposits remain strong at over 3,600 crores, growing 30% year on year. A quick update on Africa. The underlying constant currency revenue growth was strong at 3.5% sequentially. With stabilization in the Naira, reported revenue growth came in at 6.3% sequentially. EBITDA was 4,085 crores with a margin of 35.9%. The balance sheet for Airtel Africa remains solid with net debt to EBITDA of 0.9. Let me now comment on each of our areas of focus. We continue to build a diversified and resilient portfolio. The underlying performance across the portfolio remains strong. Africa now accounts for 24% of revenues. India Mobile is at 56%, and India Non-Mobile and Indus is at 14 and 7% respectively. Our investments are directed towards future-proofing Airtel and reshaping our portfolio to drive growth across segments. The second area of focus is to win quality customers. Let me start with broadband. We see strong tailwinds led by growing penetration for smart TVs and changing content consumption habits. We estimate the industry base to grow from 80 to up to 80 to 90 million homes from the current level of 46 million. To capitalize on this growing opportunity, we are focusing on three areas. First, we're expanding our market presence with continued rollout of fiber home passes and offering fixed wireless access in newer PIN codes where we've not been able to get fiber in. Over the past 3 years, we've extended our fiber network across 629 cities and are deepening our coverage to accelerate share gain. We're adding over 1.7 million fiber home passes per quarter with a plan to increase this further. Second, we continuously enhance the value we deliver by offering compelling content bundles and driving convergence. As I mentioned, we've strengthened our broadband offer through exclusive partnership with Apple TV and Apple Music. This combined with Extreme's 22 OTT apps that we've aggregated into the platform gives us a competitive edge. The third area of focus is channel expansion. As I mentioned last quarter, this was a top priority for us. Today, I would say all our channels now sell all our services, and this is continuing to accelerate our growth. This integrated approach will help us expand our footprint and drive momentum in the broadband segment. Let me now turn to mobile. As I mentioned earlier, India mobile tariff continues to remain one of the lowest globally and needs further repair. We've also said that the current telecom tariff structure in India is broken, with a one-size-fits-all pricing model, which is not appropriate for upgradation, nor is it in line with any other market. Restructuring the tariff architecture is essential to improve financial health of the industry and sustain future investments. This could simply mean reducing data allowances on some of the packs and charging more for those who can afford to pay. The other area of focus on mobile continues to be postpaid. Smartphone upgrades is a second area of focus, and driving penetration of international roaming is a third area of focus. While our rural rollout has driven our market share gain trajectory, we still have an opportunity, I believe, to sweat all our assets. We do not believe that the rollout in coming year will be accelerated. This rollout will substantially lower as we've completed our footprint today.
All right, we'll cut back to the management as and when they say something more market moving. But for the time being, just keep your eye at the bottom of your screen. By the way, when we cut across to hear out what Tata Motors had to say, as well as what Bharti Airtel have to say, take a look at what happened to the markets. The Nifty is now up close to around 80 points. And I'll tell you what, the Nifty Bank has gone ahead. If you can plot the Nifty Bank and pull up a 20 DMA, you'll see that it went to the 20 DMA and from there it's seen a bit of a bounce. So for the day, the Nifty at least has defended that 54,500 odd mark, which is approximately where the 20 DMA comes in at. And, after going down close to around, I think, 350 points, we've seen a quick 100-point bounce out there. A few stocks actually that are doing well. Tata Motors has cut its losses. Management commentary out there could have had some impact. So the stock is now down 1.3%. It was down more than 2%. And you have Bharti Airtel as well. That's perked up a little bit. Nagraj Sethi joins us on the show. Hi, Nagraj. Well, it appears like a market that doesn't want to go down. You're seeing buying coming in at lower levels. What kind of a stop loss would you have if you had a long position? And at current juncture, what would your fresh trade be?
Hi, good afternoon, Nigel. Nifty has been finding support around 24,500, 400 levels. I think anyone is having a long position at the lower levels, you can place a stop loss around 24,450 odd levels. And I'm not expecting any bigger decline from here onwards. Market is likely to test the supports and could bounce back from the lower levels. In the last 10-15 minutes, we have seen some surge from the lower levels. I'm expecting to bounce back to take place in the from next 1 or 2 sessions. And in the next 1 week, I'm expecting Nifty to reach the recent high of around 24,970 odd levels.
Okay, all right. So you're maintaining a bullish bias out there. What about individual stocks? What are the ideas you have for us?
Yeah, rightly. I have 2 stocks. One is HEG. Chartically, if you look at HEG, after a long consolidation moment, dip, it has bounced back sharply recently in the last 2-3 sessions and witnessed a decisive upside breakout in today's session above the trendline hurdle. Currently trading around 488, 489 levels. One can look to buy at this point of time. An immediate target would be around 530, and one can place a stop loss at 470, 75 levels. Second one is from the IT front, Mphasis. Mphasis was moving in a larger consolidation phase over the last few months, and it has repeatedly tested to move above the 2550, 2560 levels. Today, it has started to break above the hurdle. The overall chart pattern is looking positive. Currently trading around 2572. One can look to buy at this point of time. 2770 is going to be the upside target in the next couple of weeks, and one can place a stop loss at 2450.
Okay. Nagraj, thank you very much for that. Let's also bring in Prakash Devan into the conversation. Prakash, good afternoon. Great to have you on as always. Let's start with Tata Motors, right? We were just listening to the management and everything is fine. It's just, I think the market's also worried about demand for JLR, particularly in the markets like US. What's your sense on the stock? They've met the targets that they laid out, whether it was the margin guidance or the cash break even. So they've done well. What about the stock?
Good afternoon, Subi. So, no, I think it was a very balanced, what do you call it, explanation of sorts. Most of the stuff that got covered, which would have been, areas of concern. But they also, the management also mentioned that the US piece is still very challenging. The environment, the demand environment, it's uncertain. And especially, things around the tariff. Because remember, most of these premium cars do not have the luxury of, the cars are luxury, but the margins are not luxury. So that's where things are. And if there's any tweak in tariffs which is not very favorable, it would need much more revenue to kind of make up for the profitability that they are seeking to do. But what's interesting is, he mentioned about the slew of launches that they have. If Tata Motors were to make some sort of a comeback on, certain segments of its portfolio, the SUV portfolio, for instance, or the EV portfolio, and they are electrifying a lot of the existing popular brands like the Harrier and all, that could probably get them some very good traction. Of course, we know Mahindra is also trying to do that. Maruti's thrown its hat in the ring, but that's the space that could grow faster because of adoption metrics. But on the stock, what do? I think the stock's probably going to rest here for a while till some of these things get clear. But it starts delivering start building up a lot of value at this level of 700 odd, because you're not overpaying for anything here. Everything's been discounted to the extent that there's caution on, balance sheet, there's caution on market share, growth, margins, everything. So my sense is you'll probably see it move only when there's a little bit of that FI interest that comes back. I don't think Indian institutional or non-institutional investors are going to be very keen on buying into the stock at this point. So when the FI inflows start increasing, that's the time to probably see some move on this. But offers great value for sure, but no sparks at the same time, as I mentioned earlier.
Okay, all right. Well, we have Shree Cement's numbers that are flashing at the bottom of your screen, and the top line itself, it appears like it's a big beat out there. And remember, Shree Cement, they have exposure to North as well as East India, and out their pricing actually was much better than the remainder of the country. So it appears that the top line beat actually has percolated further down. We're waiting for that EBITDA number that should come up for you on the screen. But you're expecting a fairly decent performance. I think we're working with around 1,298 crores in terms of an EBITDA number. And margins were in the vicinity of around 26%. That's our expectations. Let's see what they delivered. Prakash, Shree Cement, there we have the number up for you. It's a beat. It's coming at around 1,381 crores. That compares with around 1,298 crores. So the absolute EBITDA number is better. The top line was better. It had a few things going for it. Quarter 3 was a washout. Quarter 4 looked much better. Volumes have come back. Realizations they gained because they have exposure to North as well as East India. And as we know, the benefit of lower input cost would have played out as well. Explains why the stock is up 2.2%. Prakash, want to come in out here on Shree Cement? Mr. Bangur was the one that the market was betting on big. And suddenly the stock seems to have lost, its momentum. It lost investor interest as well, as a lot of investors flocked towards the Adani twins as well as Ultratech. Now with the numbers coming back, it appears Mr. Bangur as well has got the right team in place and clean balance sheet. Do you think Shree Cement can get its old mojo back?
Oh, absolutely, Nigel. Absolutely. I think if you really see in the top 3-4 names within the cement bag, which would probably lead the entire revival of the sector, the re-rating that's kind of imminent. We had December end was bad. This quarter probably was a repair quarter. And these numbers that you see are part of a repair. Okay? It's not something where there's any growth, significant growth that was likely to make a big difference. But here on, and the key out there, why would one expect Shree Cement to start doing very well from here on is their capacity expansion has been done at one of the most efficient pricing. Okay, they've done it organically wherever possible using internal accruals, and they're known for that. So my sense is when the industry expands and price, hikes start coming in, volumes start picking up, they will have operating leverage that will start kind of playing out. So I'm quite positive on this. In fact, if you really ask me, between ACC and Shree, it will end up taking the lion's share of any allocations that come into the sector as we go forward. And remember, good quarters are yet to come for them. So definitely very positive. These numbers, as you rightly said, could probably give the confidence. There's nothing to complain even at these levels, which are fairly decent in terms of where it traditionally trades. Historically, it's always been trading at higher P multiples as well.
Okay, all right, got that. That's Shree Cement. Thank you very much, Prakash. Slightly shorter chat today, very heavy on earnings, so a little shorter, but thanks very much for joining in. We do have to take a very quick break on that note. Come back on the other side. We'll have Vaibhav Sanghvi join in with some market perspective. And specifically, we'll ask him about this big defense rally. Last 2-3 days, we've seen consistent gains on defense stocks. So what's the setup? We will discuss with Vaibhav in a bit. Welcome back. Well, as promised, let's straight away go across to Vaibhav Sanghvi. He's joining in, CEO of ASK Hedge Solutions. Vaibhav, great to have you with us. I mean, never a dull moment in the markets, right? And just so much going on, from trade to geopolitics to a full-fledged war we had almost at our hand, right? So what's the sense? I mean, the market got the twin bonanza, the great news of at least, an end to hostilities right now between India and Pakistan. Then we had the news on the China deal, China-US. So there was a quick reaction. But the worry that I had, and that's what I wanted to ask you, I was discussing this at the start of the show, is that tactically, it seems there's a shift towards China, right? We don't know how long it lasts or not, but it's very evident in the way the markets have been reacting last 2-3 days. Is this potentially a risk in terms of flows and the large cap performance for India in the near term?
Absolutely right, Sylvia. I think because of the announcement of a 90-day period for the trade deal to be negotiated, in my sense, I think there is some amount of preference or some amount of reshuffling happening towards China. Doesn't mean that it is completely going from India, but on an overall basis, what do I think is basically that if the overall flow is coming to China or probably emerging markets as a basket, then India would be a beneficiary of that flow in any case. Of course, if it's not coming to an emerging market basket, then probably there is some amount of reshuffle towards China. But in my view, I think as things have steadied and as things appear to be on the constructive path, my sense is basically that emerging market flow on an overall basis, will start increasing. And there is a correlation that, whenever China sees a good amount of interest in terms of the flows, doesn't necessarily mean that it is coming from the other emerging markets, but it is actually coming towards a whole basket, wherein India tends to be benefited.
Okay, so perhaps we need to see how the flow situation plays out. But otherwise, Vaibhav, let's leave that aside. I mean, that's a flow situation, tactical. We'll see what it brings. Otherwise, how do you rate the earnings season? And now that like I said, we've had the two good news pieces. Markets bounced back very smartly. We're some 4.5%, 5% away from the all-time highs. How do you see the next 6 months?
No, of course, the macro events, which were headwinds, from a market perspective, are now behind. One, of course, is the tariffs, and the two is the geopolitics. And it is a situation where markets will start looking at earnings, valuations closely. Having said that, this earnings season, barring one or two sectors, I think the earnings have been pretty decent and a little marginally higher than the expected kind of run rates. What do we also expect is basically going through the year that a combination approach of combined effort, both from the fiscal side in terms of tax rebates, which we have already seen, and two from a loose monetary policy in terms of liquidity being better, rates decreased, and risk weights kind of taken off from the unsecured piece in some segments. My sense is basically, I think we will see revival or probably GDP growth surprising, on the higher side as against your, street expectations, which is where we do think that in the second half of this year, we may see some amount of revival of earnings also starting to happen.
Okay, all right. Hi, Vaibhav. I wanted to ask you about the defense space, because from everyone quizzing about how expensive these stocks are, now everyone is asking, what's your allocation to the defense stocks? I'm going to come and ask you that question itself. For the time being, though, let's hop across to my colleague Ria, who's here to tell us about Garden Reach Shipbuilders as well as HAL. Both of them are buzzing post their numbers. Ria?
Well, yes, defense and shipbuilding stocks have been in focus yet again today. And let's talk about the three big movers. The first one is Garden Reach Shipbuilders, which reported quite a healthy set of numbers yesterday. The revenue saw an increase of around 62% on a year-on-year basis. Even the EBITDA and net profit jumped up by 144% and 119% respectively, both on a year-on-year basis. EBITDA margins also saw an expansion of 454 basis points, coming in at 13.5% in this quarter versus just about 8.9% that we saw in Q4 of last year. For the full year FY25 as well, we've seen good growth on all fronts. The net profit margin was also above the company's guidance of over 8%. The order book details haven't been disclosed yet, but the company did say in their Q3 earnings call that they expect the order book to come down to about 22,000 odd crores as execution is picking up, and the order book at the end of Q3 stood at about rupees 23,877 crores. Some key things to watch out for GRSE going ahead will be the management's comments on order book and execution, and also an update on the delivery of one of their key projects, which is the 8 ASW shallow watercrafts, all of which are expected to be delivered by October 2026. And remember, the first ship was delivered by the company to the Indian Navy just last week. The stock is trading with gains, very strong gains of around 17 to 18% today, but still down about 20% off its 52-week high. Cochin Shipyard is also trading with gains of up to 13% today in a rub-off effect from GRSE, and this company is also expected to come out with a good set of numbers tomorrow, so we will be watching out for that. HAL is the third stock that we'll be talking about, up around 3 to 4% after reporting a good set of numbers today. The revenue did go down by around 7.2% on a year-on-year basis, but this was off a high base. The net profit and EBITDA also declined by around 10% and 7.8%, but they were significantly higher than our estimates. EBITDA margins came in at 38.6%, down about 129 basis points on a year-on-year basis, but still well above our expectations of 27.6% margins. Order book details again haven't been disclosed for HAL, but they do have an FY26 order book target of about rupees 2.6 lakh crores. Some key things to watch out for in the earnings call on Friday will be the management's comments on the LCA Mark 1A delivery timelines and further engine deliveries from General Electric, improvement in working capital execution schedule of ALH, and of course the management's comments on the order book and execution ahead.
Hey, thanks a lot for that, Ria. Vaibhav, that's the question. What's the allocation to defense? What this recent skirmish has showed is that this equipment is battle ready. India is focusing more on indigenizing the defense equipment here in India. And as our defense minister said, that the exports of defense equipment from India to the globe can reach 50,000 crores by 2030. How interested are you in this space?
I think I am hugely excited about it. And, I think what India has shown to the world, and with some sense of pride also, I can say that I think it is, what India has achieved in terms of defense production, in terms of technology, I think it's just outstanding. What we've seen is probably an inflection point for the defense exports likely to happen from India. In my view, I think the order books are likely to balloon, and what better way in terms of showing the product performance in that sense of what we've seen in the last week. So in my view, I think it's a much of a very long-term story here now. I'm not talking about a shorter-term perspective, but the order books, in my view, are likely to swell or balloon pretty quickly going forward.
Okay, so I mean, you still see some value given the fact that there's growth ahead in defense. That's right, Vaibhav?
Of course, because here it is very difficult to put a P valuation matrix here. In the light that when your order books are going to exponentially rise or likely to exponentially rise from various other countries, my sense is this opportunity will be captured by our public companies which are doing some excellent work.
Sure. Okay, so that's one clear theme. Defense, you think, still has some more legs to run. What else, Vaibhav? Because this market doesn't have too many growth ideas, right? Clear growth ideas. Large sectors are still struggling in single digits or mid-single digits. What else are you liking?
So I think one difference which I did mention earlier is basically one of the bigger headwinds, from the global perspective, which is your tariff-related stuff, I think has kind of eased off. And any incremental news regarding that is not kind of having an impact on the margins or impact, on the sentiment of the markets. What we do see is because of this, the overall worry, of IT discretionary spend, which are likely to kind of get suppressed because people didn't understand, how the situation is likely to pan out. I think now it is very, very clear that deal will be done, whether it is a matter of 1 month, 3 months, or 6 months. So all in all, I think the confidence of the companies to do business, to expand, to spend on IT is likely to come back. In the wake that I think IT as a sector, we've seen good correction in terms of the valuations. My sense is basically, I think we should be looking at as a good opportunity from here onwards to kind of invest in. Lastly, I think because of the rate movements, likely rate movements, there can be a shorter term pressure on the banks in just for the sake of worries in terms of the rate kind of gets reduced, then probably there can be some amount of margin pressures on the NIMs. So we'll wait for the bank rate cut to happen to probably get into the frontline private banks post thereon.
Okay. All right, Vaibhav, got that. Good perspective. Thank you very much for joining in today. And we look forward to the next call soon. Thanks for joining in. Well, with that, we'll take a quick break. Let's quickly have a look at the market. The market, mid-cap's absolutely rock steady. No problems there. Nifty is actually trying to find some mojo back. 82 points higher on the Nifty. That's the mid-cap index. It's always been steady. There you see the Nifty is trying to sort of pull back from the day's lows. Let's take a break, come back, and we will get you a check on the dealing room chatter today. Nimesh will join in. And then, of course, some final trading calls as well.
Welcome back. Well, the markets are still holding with good gains. By the way, we have a cabinet meet outcome out there. The cabinet has approved HCL Foxconn JV for this semicon plant. So I think we'll wait by. I think Ashmit is bringing us this information. It's the HCL group, keep in mind, not HCL Tech, which is the listed entity. So I think that as well should come up as an alert. We'll get back to that. For the time being, let's hop across to Nimesh. He's here to tell us what he's picking up in D Street Chatter. Nimesh.
Hi, Nigel. While the Nifty has been consolidating, it's the second day running or the third day running, the broader markets are relatively outperforming. So again, a day when a lot of individual broader market stocks are buzzing in trade and the volumes are also picked up from retail and HNI categories. So that's the space which is really doing good today. From a sector perspective, it's the defense which has done well for the second day running, and add to it, the metals have also done well. But within the defense names, it's the defense PSUs and overall PSUs which are well bid by larger institutions. So, this rally in the PSU stocks is backed by some bit of institutional buying as well, is what I understand. Overall, the flow seems to be quite mixed today. I understand there is going to be a small marketed close basket selling at a leading FID. So maybe you'll see some pressure on some nifty names in the last 30 minutes of trade. But barring that, largely it's the broader markets which are seeing the momentum, and clearly looks like it's backed by institutional buying, as well as some bit of interest is back from larger HNIs and retail investors as well.
Okay, all right, Nimesh, got that. What about individual stocks? What are you picking up?
Well, Nigel, so I'll continue with the theme of large blocks. So, a couple of mid-cap names where I'm expecting large blocks very soon. One is Kirloskar Ferrous, and the other one is Segality. In both the names, I'm expecting large block deals very soon. So, watch out for those. Second, couple of PSU names where there is a bit of buying interest, which is BHEL and NBCC. Both are actually buzzing in trade today. The volumes have also picked up. And I understand a leading domestic mutual fund has done fresh, buying or fresh additions into both these names in one of the small cap schemes. So that's the reason why those stocks are buzzing in trade. The third stock is BEL. I spoke about defense as a theme doing good. BEL stands out in terms of very aggressive buying from larger institutions as well as some larger family offices as well. So expect high delivery volumes on the buy side in BEL today. And the last name is Birlasoft. While post earnings, it's been a bit of a weak stock, has been consolidating of late. But even in Birlasoft, for the last couple of days, I understand some domestic mutual funds are accumulating at lower levels. And also in Birlasoft, there is a strong buzz of some corporate development as well. So that's the reason why it looks like some bit of domestic interest is back in Birlasoft.
Okay, all right, Nimesh got that. So watching out for all of these stocks that are buzzing around on different pieces of news. Thanks for joining in today. Well, with that, let's quickly go back to Nagaraj Shetty, get some final trading ideas. Nagaraj, so what do you think? What's the final advice on the index positions and also any final stocks?
Yeah, index, I'm remaining bullish. Market is showing some strength at the supports, and I think more upside is likely to come in the short term, at least in the next 2 to 3 days. And the stocks, I think I have discussed the stocks. Right now, I have one more from the railway front, IRCON. If you look at the chartically, IRCON has been in a consolidation phase over the last couple of months, and today witnessed a decisive upside breakout of the range, currently moving out of the range. The overall chart pattern is looking positive. I think this upside momentum is likely to continue for some more period, and currently trading around 172. I'm expecting this to move up further. 188 is going to be the next hurdle, which is near to the 200-day EMA in the at least 1 to 2 weeks.
Okay, got it. All right, Nagaraj, thanks a lot for that. By the way, let's focus on a couple of other stocks in the broader markets. Apar Industries, I recall that stock saw a sharp downtick here in the last couple of quarters. But these quarters' numbers actually look good. I'm looking at Aquarius Note, and they're saying that the EBITDA number actually beat their estimates by close to around 20%. The EBITDA number itself has come up by close to around 29% on a year-on-year basis. And on the revenue front, it's just 3% ahead. So bulk of the beat has come in because of the EBITDA margin beat. And that's why that stock, I think, is fairly excited. But let's talk about Tata Steel. Tisco's done the disco today. Remember yesterday, actually, to be fair, we here at CNBC-TV18 had put out various alerts that these numbers actually were quite good. And the management as well, in their commentary to me, they were very, very positive. So 3 big points they made when they spoke to CNBC-TV18. One was on pricing. Indian prices are up by 3,000 rupees per ton on a sequential basis. Even European prices actually were looking up by around 22 to around 30 euros per ton. So that was on pricing. Coking coal cost, the cost of consumption per ton, that's likely to fall down by close to $10 per ton. So higher prices and you'll have lower input costs. That's obviously going to help the margin aspect. On EBITDA, all eyes were on Europe. When do they see it turn around? They said in this quarter. That's quarter 1 FY26. Some were expecting Europe to turn around in quarter 2 or quarter 3. But they are saying from the first quarter itself. And the UK business, which is a sole part of Europe, well, they are saying that will turn around in the next few quarters. Novama, they've gone ahead. They've upgraded the stock. They have a target price of around 177. The EBITDA estimates they're upping out there for FY27 because of higher profitability at Europe and lower fixed cost. Also, Novama goes on to say that in quarter 1 FY26, they are expecting the EBITDA per ton to improve by 2,000 rupees per ton. So good going for Tata Steel. Yesterday, the commentary was positive, but the markets were a bit of a risk of was playing out. Today, metals are doing well, and Tata Steel is participating, one of the top gainers on the Nifty today. Survey.
Absolutely, Tata Steel doing extremely well, in today's trading action. The other group company, that's Tata Steel, Tata Motors is something that we've been discussing as well. Like we've been mentioning, the fourth quarter performance kind of hit the mark on most notes, but I think it's the commentary about the future, what's happening with global tariffs, and one of JLR's big markets, the US. That is something that's been weighing on the stock. Sudarshan is joining in. Sudarshan, I think you must have also heard a bit of the commentary that Parikshit got from the management. So what's the takeaway? Q4 and looking into this year, what do you make of Tata Motors?
Tata Motors yesterday post-market had reported earnings for Q4 FY25, and those earnings were largely better than estimates. But why the stock is under pressure, it's down almost 2% currently. It's on the back of the cautious outlook. Company is saying that in China, things are not that great, while the situation has improved a bit in UK and Europe. But the problem related to the tariffs are going to be an overhang, and the company is saying that exports that would be done from UK plant, for that tariff is increased by 300% to 10% from 2.5%, and exports to be done from EU plant, for that tariff would be increased to tariff would be increased by 3,000%. So those will remain an overhang. Now, after that, majority of the brokerages have turned negative. But first, I'll start with the brokerage which is positive. That is CLSA. It maintains outperform call, and target is 805. It says Q4 earnings have met estimates, but JLR is cautious in demand in FY26. But company is confident in delivering EBIT margin for FY26. Jefferies maintains underperform call, target is 630. It says Q4 EBITDA was down 2% year-on-year, but 4% higher than the estimates. But it believes that JLR may have a tough FY26 on tariffs, increasing costs, and increasing competition in China. It has cut FY26-27 EBITDA estimates by 8%, but has raised EPS estimates by 3 to 4%. Nomura has downgraded the stock to reduce, and target is 799. And Kotak Institutional Equities has downgraded the stock to reduce, and target is 600. So earnings were above estimates, but on the back of cautious outlook, stock is under pressure.
Okay, all right, got that. Sudarshan, thanks very much for that. Let's move on now. REC has been under pressure after cutting its guidance. The AUM growth guidance now stands at 11 to 13% versus 15 to 17% earlier. Vinny is here with more details. Vinny, you were listening to the conference call. So why has REC sounded this very cautious, subdued note now?
Absolutely. So this guidance cut is mainly coming in because of the repayments that have happened, and that is much higher than what was anticipated. So yes, that is the main concern coming in. So in Q4 also, that was the main impact. Now, because of this, AUM guidance has been cut to 11 to 13%. Previously, the guidance was around 15% is what they had spoken about. Until Q3, they were very confident that in Q4 also they would be able to achieve this. But yes, there's a change in stance that has come in for FY26. But other than that, they're expecting the loan book target that they have for around 10 lakh crore crore rupees by 2030. That stays as it is. They're targeting a 12% annual loan book growth. Their NIMs, they're expecting in the range of around 3.5 to 3.75%. And that will mainly be supported by infrastructure lending. That is expected to contribute to the NIMs as well as the spreads going forward, and especially in FY26. Regulatory environment, they highlighted that it was quite stable during this quarter and not much of a concern on that front going forward as well. They're targeting a net zero NPA status by FY26, and generation projects that has yielded around 10 to 11.5%, and that is expected to support the margin sustainability going forward for the company. So these are the overall key highlights, but we're seeing the stock falling in trade today mainly because of that cut in AUM guidance.
Okay, all right, Vinny, but it's your day. The spotlight's on you. We can't let you go just at the REC guidance cut. You've got a few more stocks that you're tracking. Good going, girl. Tell us more.
So yes, keeping an eye on a few more stocks. Couple of pharma names that we have today. Sai Life Sciences, that's the one in focus today. Good set of numbers that came in from the company. Revenue up 32%. Margins, yes, a bit of a compression and contraction on that front. 27.2% versus last year, 28.4%. But when we spoke to the management today, they did highlight that they are aiming for a 15 to 20% annual growth over the next couple of years, as well as in terms of the margins, they're expecting that to be in the range of 24 to 30%. So we could see an improvement further in terms of margins going forward in the next 3 to 5 years. So Sai Life is something that is buzzing in trade. Now, Metropolis Health on the other side has seen a weak set of numbers that's come in. We're seeing an impact coming in because they made a lot of acquisitions this time. And because of that, we're seeing an impact coming in on the numbers of the company. So margins are contraction because of that. This time what we saw was Core Diagnostics didn't support in terms of margins. That is the newest and the latest acquisition coming in from the company. Profits of the company were down by 20% as well. And they've seen lower than usual revenue in the month of Feb in their focus market, which is also leading to lower revenues than what one was expecting. And that is why an impact in terms of the overall performance of the company. Lastly, Sirma SGS also is in focus. Now, this is a good growth that one has seen in the company, especially in terms of the margin, which came in as a surprise, 11.6% versus 6.5%. Even the estimate was around 7.9%. Other than that, they spoke about the growth in FY26, 30 to 35% growth. Product mix is something that will be driving the growth. EBITDA margin 8% guidance is what they've given on a conservative basis. So we could see furthermore higher margins on that front as well. And they're sticking to the 1,000 crore export target by FY26. So that is why Sirma SGS also is a stock that is in focus today.
Okay, all right, got that. Thank you very much for that neat wrap. Quite helpful, Vinny. Thanks for joining in today. Let's discuss some of these trends in these stocks with Anand Tandon, who's joining us now. Anand, thanks for joining in. I want to start off by asking you about the EMS space. And we caught up with two companies, discussed numbers today with both PG Electro as well as Sirma. So the management still sound quite optimistic about their order book, about growing the business. They're putting more money to work. But the theme has also had a fantastic run till the market correction set in. What would your advice be on some of these companies, whether it's Amber, Dixon, or the others that I mentioned?
Mostly it depends on the kind of product one is making. If you're looking at very low margin products, there is a little bit of an issue because it depends mostly on the PLI. So for example, the mobile phones, they have not yet managed to scale up their product to a level where the margins become sustainable. And you'll see an operating margin of still around 4% or thereabouts, which if you assume that there is also a 6% PLI benefit from the government, means that you're not really making any money there. So the others are not so bad. They are actually doing quite well. Some of the other smaller players are perhaps even making double digit or even mid-teens or higher teens margin, which is obviously very good. The space is something that is expanding, and clearly it has potential to go more from here, because no matter what happens to the China kind of market, there is no question that people will want to diversify, and India, so long as it is able to support and expand the product portfolio, will do quite well. But as you said, I think that most of it is in the price and then some. Especially for those companies where the margins are low, there is always a problem that a small hiccup in one quarter can actually upset the entire apple cart in terms of the valuation. For the others, not so much. But again, the valuations are such that there is no scope of a lack of execution. So, anyone holding on to it, especially the higher margin product companies, would do well to stay invested. But keep an eye out for any kind of slowdown in terms of the execution capability, because you are betting for very large growth.
Okay, all right. Hi, Anand. Good afternoon. Good to see you, Ben. What about the pain stocks? The numbers yet again from the leader Asian Paints was disappointing. But the hope is that, say, in the second half of this fiscal, things improve. It's anyone's guess whether it will improve or not. But at least valuation-wise, it's more palatable. Good enough reason to buy into the stock, or you believe the competitive intensity as well is going to keep the lid on some of these valuations, on pricing as well, so you stay away from a stock like Asian Paints, which is the top Nifty loser today?
So you have to keep in mind that whenever management or analysts say that the second half will be better, which means 6 months down the road, what they are really saying, we haven't a clue. So the best way is to avoid it, right? Because when people are fighting for market share and for establishing themselves, they are not going to be satisfied, especially the new players who've come in with deep pockets and large relationships in the trade. From getting a marginal market share. You are expecting to see something like when Jio came in, the kind of tectonic shifts that happened in the telecom. I would expect that you would see similar kind of market share changes. So the incumbent is under threat, and you will, no matter what they do, they will have to fight to maintain their market share, and that will mean that they will have to erode on margins even further. If they don't do that, then their volumes will drop. So either which way, it's a no-win situation for the incumbent. It is best when fights like this happen that you stay away, and until and unless the market share is established, it is you shouldn't be looking to find winners in the space, because the people who are trying to get in the market are going to fight hard tooth and nail and not worry about the bottom line, and those who are incumbent are going to lose money to be able to keep their position where they are. Like I said, remember this. It's something that I've learned over years of experience. Anyone saying next half is good means he doesn't know what he's talking.
All right, and we've seen a fair bit of that over the last many quarters in the market. Anand, stay on. We'll come back and have some more questions for you in just a bit. But right now, a break. Back with the market close in a while.
Welcome back. Well, let's before we wind down on markets, let's throw a question to Anand Tandem. Anand, I wanted to ask you about Coal India. Any view on that one? Because that's a stock actually normally people like to hide in. There is dividend yield. Valuation is not very, very expensive. And they have a good amount of cash in their books. Good enough reason to buy it. It's corrected a fair deal from the top. Or would you stay away?
No, as you said, it is actually a high dividend yield stock, and there is no doubt that it will continue to generate the kind of cash flow that it does. It is not a very favored stock from an institutional investor point of view, especially those who are worried about ESG, etc. Because obviously there are problems in terms of using coal for the environment, and at some stage, while that has taken a backseat in the current environment, it will come back at some stage later. But given the fact that we are continuing to push thermal energy, and that is going to remain a mainstay for India's power, we will continue to need coal. So both in terms of volume growth potential as well as cash flow generation, I don't see that there is any sustainable problem. It's just that their inability to expand quickly has always been a problem for them, and that continues. So while they do make incremental increases in top line, it is still that it is incremental and not dramatic, which is something one could have easily achieved if it had been private sector player. But on the other hand, like you said, it's probably reflected in the price.
By the way, today has actually turned out to be a really good day for PSUs overall and across market capitalization. Coal India would be one example, but look at others. Railtel, Aircon, as we are closing, Railtel is up 9%, Aircon is up 8%. The SAIL, Nalco, of course, that's the entire sort of metal story that's been quite strong. But even otherwise, lots of these names, RVNL, IRFC, a lot of railway names doing quite well.
There are many stocks actually, Surbhi, from the broader market. Just to pull up a few, JG Chemicals, pull up this stock. That's, some of these stocks have seen a sharp correction, but they're the top volume mover. So that's why I'm just pulling them up. So JG Chemicals, Reliance Infra, the stock from 350, it came down to around 200 rupees. Now it's in the last, I think, 2 weeks or so, it's bounced up close to on 20%. Supreme Petro, another stock that's seen a fair correction. Last Friday, there was big volume out there. And today as well, the stock has spiked up. And I think Prakash Diwan had spoken about this other defense name, DCX.
Systems.
Just take a look at it. From 280, I think he spoke about it on Friday. Today it's at around 330. But you need to keep in mind, the stock was at 400 rupees earlier. So even after such a big pullback, still, in fact, they're a far cry away from the highs that we saw earlier. 8% in today's trading session. Massive volumes is what we have seen out there. I think let's wind down on markets, and then we'll get to talking about stocks on markets forward. Well, for the time being, the markets go home with a century. The Nifty goes home with 100 points. But remember, during the course of the session, we even went in the red. What did well in today's trading session? Metals. They were the guys that got whacked yesterday. There was a bit of risk off that played out. But now the globe seems to be in a better place. And the hope is that with US and China getting onto some kind of trade deal, at least the global recession is averted for the time being. Tata Steel's con calls details were good. With their, their commentary to CNBC-TV18 as well was fairly positive. So that one bounces up close to around 4%. Shriram Finance got smacked post its results, but that one as well has bounced back. It was up 3%. And BEL, one of those defense stocks from the Nifty pack, that did well in today's trading session. Coal India and Tech Mahindra as well add to the winners list. On the flip side, Asian Paints, the stock was down close to 2%. Cipla as well, a day after its numbers, the stock was down 1.5%. And you had Tata Motors, there is that fear that yes, UK has struck a deal with the United States, but Europe still needs to strike a deal. Also, there are stranglehold on the EV market share here in India. That's fallen from around 65% to around 42%. So because of some kind of jitters with regard to the outlook, that stock is well under pressure. But winners, plenty from the broader markets. Garden Reach Shipbuilders, HBL Engineering, Railtel. Surbhi, take it away.
No, absolutely. It's a long list, right? Even a stock like MobiKwik, imagine that. 8% up, having such a good day. Dredging Corporation, about 11% higher. And then a whole host of other, PSUs that we've been talking about. Cochin and Garden, of course. But even otherwise, a lot of the railway stocks have come back after a long time. Railtel, Aircon, IRFC, all of them seeing gains between 4% to as much as 10%. Big day out there. And of course, then the PSU metal names as well, like SAIL and Nalco, having a very good session. HBL Engineering, some more names, Titagarh Rail. So the railway pack, PSU as well as private, was very, very solid today. And let's not forget something like a Mishra Dhatu Nigam, 15% up on Mishra Dhatu, Midhani. Good day. Rallis India, as we've just heard the bell go off, 13% higher. So the broader market alive and kicking. Mid-caps, slow and steady was the mood today. Well, with that, it's a wrap on this edition of Closing Bell. Many thanks for watching, but do stay tuned. Markets Forward comes up next.